It's time to start trading from the right order block. After this video, you'll be able to point out valid order blocks. You'll be able to refine those you're not meant to be trading from and stick to the valid ones. So I'm going to state the rules you need to see present before pointing out your POI, that is your order block. So make sure you watch to the very end. I've gotten the question a lot on how to map out the order block out of your origin. So in today's video, it's going to be straightforward. So watch to the very end, guys. Let's go to the chart. We're going to start with the meaning of order block. Order blocks refer to specific price areas where large market participants, such as institutional traders, have previously placed significant buy or sell orders. Now, let me use an illustration to explain this particular definition, because it's just a very straightforward and simple definition. So remember, our strategy, if we get a break of structure like this to the upside, we are waiting for price to come and tap into the origin that caused the break of structure, then for price to keep pushing to the upside because it has created a break of structure here. So we're expecting price to retrace back into the origin that caused the break of structure to dish out a buy. Now, this impulsive movement that caused this break of structure, that we have here, this impulsive movement that caused this break of structure is actually the buy that has been placed here by institutional traders. So the idea behind the order block is that since an order has been placed here, we're expecting markets to come and retrace into this particular level where order has been placed, which is what we call our order block. We're expecting market to come and tap into this particular level and clear out other, unmitigated orders here. So once price taps in there, we're expecting it to finish up the unmitigated orders here and push again to the upside. So that is the meaning of order block and the idea behind the order block we trade. So let me clear this. We're going to look at the major rules from the second box, which is here. The major rules for order block. So for you to get a valid order block, these are the major rules you need to see present. Number one, it must break a structure or cause a change of character. So markets may be moving and maybe you've pointed out an order block, but make sure that the impulsive movement that you've noticed actually clear the structure. If you don't understand the meaning of break of structure, you can check out my video on break of structure to understand that. So make sure that any other block you're mapping out has broken a structure or has caused a change of character. Number two, it must be unmitigated. Now, what I mean by unmitigated is make sure that your order block price or market has not tapped into it, because once market has tapped into an order block, it is no longer valid. It will become liquidity zone. So make sure that the order block has not been tapped into, that is, it must be unmitigated. The next one is imbalance must be present. Now, following the entry strategies we use, with SMC strategy, imbalance is actually one of the entry strategy. But for me, I don't take my entries from imbalance, that is FVG. I take my entries from order block, and imbalance will be present to give more validity to my order block. So imbalance is more like one of the confluences I need to see present for me to consider my order block valid. So imbalance must be present. The order block you are mapping out, it must be the last candlestick reaction in an origin. Let me use an illustration to explain that. So you noticed a range. Whenever market is ranging, that simply means both the buyers and the sellers, they are indecisive. So whenever market is ranging, once you get an impulsive movement, either to the upside or to the downside, here we're going to use to the upside. So inside this consolidation, now, price kept on, they were fighting both the bulls and the bears until the buyers, cleared to the upside. That's winning the fight. So all the consolidation inside here is what I call origin generally. But if you want to map out your order block, you need to look for the last candlestick inside the consolidation. That is inside the origin. You look for the last candlestick reaction. It can be bullish candlestick, it can be bearish candlestick. So just look for the last candlestick before the movement that caused the order block. That is what you map out from the opening to the closing and extend it, because that will be your trap. When we go to the chart, you understand clearer. So this is just an illustration. So we're still on number 4. It must be the last candlestick reaction in an origin. Then liquidity sweep is a plus. Now, what I mean by liquidity sweep, you may notice other blocks like this. Let me use an illustration again. You may notice other blocks with weak rejection, that is, market cleared liquidity before it started pushing to the upside. So it's kind of a plus to our strategy. Let's say you notice other block candlestick like this, and you notice that price cleared liquidity before it started pushing. So this weak rejection is more like a liquidity sweep. It must not always be present. That's why I said liquidity sweep is a plus. So once you notice that your order block cleared liquidity, your order block candlestick cleared liquidity before the main impulsive movement, that cleared a structure, it's also, valid. It adds more validity to the order block. So once you map it out, you just patiently wait for price to come into that particular origin. So that weak rejection, that is, it's more like a plus to the rules. So if you notice it, it makes the order block more valid. So I've also stated where it works, like when it works. And number 1 here, it works more when market has a direction. So if you have finished reading the market structure, you should also understand how to read market structure if you want to do well with this particular strategy. I also have a video on that teaching you how to read market structure. So if you read the market structure and you notice that there is no direction in the market, you need to stay away, because you may not get the setup you are looking for. But once you read the market structure and you notice that there is a direction, and the direction is either to the upside or to the downside, then your order blocks can work well. We also have number 2, it also works more when the market is volatile. So it's more like something with when the market has a direction. So volatility in the market simply means how high the momentum is. So when the market is giving out, good movement, and it's not just slow, like during Asian section, market is always slow. But during London and New York section, you will get the movement, the momentum you are looking for. So it works more when the market is volatile. And you need to make sure you are sticking to the recent order blocks. That's what I mean by recent OBs. So don't go and map out, unrealistic order block and expect market to get there. You may be missing out on your entries. So make sure you work with recent order blocks. When we go to the chart, I'll clarify that. Then allow the price or the market to clear liquidity. If you're also confused on what liquidity means, you can also check my video on liquidity to understand it. So allow the price to clear liquidity. Let's say we have a break of structure and you've noticed the market is kind of ranging around here. This being your origin where you're waiting for price to get to, and you notice that market is playing around here, don't be tempted to get in. Wait for price to clear this liquidity before tapping in, and then it will move to your direction. Because if the liquidity the market needs to sweep to tap into your origin is not present, then that simply means your origin or your order block will turn to the liquidity. So we're going to open the charts now. I'm going to show you guys some of the trades I've taken, how all these rules were present. Because if I don't see them present, I'm not taking my trades. That is how I do my peace of mind, keeping everything simple. You don't need to rush it. So I'm going to show you guys examples of some of the trades I've taken, and then after this video, I'm going to drop a link where if you do your own analysis, map out your own order block, you can go ahead and send, to show me. If you're correct, that will be commended. But if you're not, you'll be corrected. So let's go to the chart. So this is a sell I took on BTC USD. So noticing the trend from my entry time frame, after pointing out that BTC was bearish, so I came to my entry time frame, which is 15 minutes, to look out for ways to join the trend, that is the bearish trend. So pointing out a break of structure here to the downside, another break of structure here to the downside, then this being the most recent break of structure when I was looking at the markets here, the most recent break of structure. Now Remember, I talked about origin. I stated that the consolidation that will be happening before an impulsive movement. Now, this impulsive movement that cleared the structure, that is actually the order that has been placed. Now, this consolidation is actually when both the buyers and the sellers, they were more like indecisive. So after the consolidation, the sellers, cleared everywhere. That simply means the sellers, actually won the fight. So this impulsive movement simply means that an order has been placed here, which is causing this massive sell-off. So what I did from the consolidation, I looked out for the last, take note guys, the last candlestick, which is this bearish candlestick here. And I mapped it out, measuring the height of the candlestick, that is from the opening to the closing, and I extended it as the trap. So as an order has been placed here, triggering this impulsive movement to the downside. The reason for this particular order block I've mapped out is for market to retrace back into that origin and then finish up the orders here, finish up the unmitigated orders. So looking at it, from the origin, you pick the last candlestick reaction. Remember, I stated it can be bullish, it can be bearish, but just make sure it is the last candlestick reaction. You measure that and then you map it out. Now, if you check from the rules I stated, you can see we have our FVG present, which I mapped out here. That is it, FVG. So imbalance must be, present for your order block to be valid. Most people may ask, if the imbalance is not present, is it a good trade? It can be a good trade, but learn to stick to your A plus setup, because if all my confluences are not intact, I'm not taking the trade. So it must be an A plus setup for me before I click the buy button or the sell button. So there is no need to rush in taking premature entries. Wait for everything to be present, then you take your trades. So looking at it, my imbalance present, and you can see the liquidity price cleared before tapping into my origin. So this dollar sign you're seeing here simply means liquidity. So price, you can see when price got here, it was, trying to more like trick me into taking trades from there. But I waited patiently for market to get into my origin, and you can see immediately it cleared the liquidity, tapped in, we dropped to the downside, and this trade dished out 316 pips on BTC. Very clean. Make sure you follow the trend, and once you get a break of structure, remember the rules. The other block must cause a break of structure, which is here. And then when you map it out, you look out for imbalance, liquidity that price will sweep, and it must be the last candlestick that's the last candlestick reaction before the impulsive movement. Let me also show you guys another example. This is another beautiful entry that is a sell on GBP JPY. This particular trade dished out a lot of funds for me. Now, the market is bearish. You can see break of structure to the downside, break of structure to the downside. And then when I was looking at the market, this was actually the most recent break of structure. You can see that clearly. And everything inside here, they are all consolidation. So all of them is what I call origin generally. But now, if I want to set my trap, I'll look out for the last candlestick. Now, let me zoom in so that you will see. This is the last candlestick. Now, this is a bullish candlestick. That's why I said when you're mapping out your order block, whether it is a bearish or a bullish candlestick, just make sure it is the last candlestick reaction before the impulsive movement. Now, you can see the massive sell-off here. So after this consolidation, a sell order was placed here by institutional traders, market movers, which triggered this impulsive movement that cleared this structure to the downside. So all I did was to map out the last candlestick reaction, highlighting it from the opening to the closing and then extending it. Now you can see price rallied back, tapped into the origin, and dished out massive movement for me. So in here, I was just risking 38 pips to catch 169 pips. So it's a trade of 1:4 risk to reward ratio. Now, checking for other rules. Is my imbalance present? Of course, this is it, FVG. Where is the liquidity price cleared, before tapping into my origin? This is the liquidity present. And you can see immediately price cleared my liquidity, tapped in, and it pushed to the downside. Having in mind that if you have one of them missing, that trade is not an A plus setup. And if your liquidity is not there, having in mind that your origin or the order block or your POI that you mapped out may be the liquidity, and price may end up stopping you out before moving to your direction. So just make sure everything you are doing on the chart is clean, precision entries. Make sure that all your confluences are intact. Let me also show you guys another example. Now look at this beautiful buy on XAUSD, that is gold. So you can see market cleared structure to the upside here. And if you check, price came back into the origin that caused the breakout structure. You can see it, a little tapping, imbalance present, and the rest. But this is what I want to show you guys because this is one that dished up funds for me. I didn't place this one. I missed this. So, but this is me just showing you guys how to map out the order block. You can see inside here, the consolidation. What did I do? You highlight the last, candlestick before the impulsive movement. Now, after price tapped into this particular origin, it dished out another break or structure to the upside, which we can see here clearly. So inside the movement, the origin, everything inside here, they are all the origin before the impulsive movement. So inside there, all I just need to look out for carefully is the last candlestick that caused the impulsive movement. That is the last candlestick reaction. And I will highlight it. That is my trap. That is how I set my trap. Very simple. So once you highlight that, you now start looking out for other things that need to be present before price will tap into your origin, that is giving the order block more validity. Now if you check, we have our FVG present and we have the liquidity. So you can see after price cleared the liquidity, it tapped in and immediately price pushed to a direction, dishing out massive number of pips. So this is just how simple I keep it. Mapping out your order block. Inside the consolidation, look out for the last candlestick, guys. Last candlestick, that's all. And make sure that there is a break of structure. Then after the break of structure, look out for other confluences, FVG, liquidity, that price will sweep to tap in. That's how you keep it simple and you take your trades in a well refined way, guys. So I'll allow you guys to go ahead and, go and do the practice on your own chart. Because like I stated, this video is meant to be very simple and straight to the point. So there is no need, beating around the bush. So make sure you practice because practicing will make you more perfect. If you just watch and go and sit down, then that simply means you're not ready to pack out the funds out of the market. So now that you've seen how I, refine my entries, taking my trades from the last candlestick before the impulsive movement, the last candlestick reaction, that's the precision entry. So stop taking your trades wrongly or mapping out your origins wrongly. So go and practice on your own chart. A link will be in the description. You can message me with your setup and I will see whether you are mapping it out widely. So guys, thanks for watching and expect more videos.